So today we have a look at the oil industry. The oil industry, as we all know, has been on a free fall of sorts since 2014. So previously, the most I anticipated was that oil price would stick around 40 to 50 US dollar, but then apparently it has fallen even below that, touching a low of mid-20s. So let's have a look and let us explore together what is in store. So what's happening in the oil industry? It fell from a high of US $108 in June 2014 to US $31.98 on 28 January. This is equivalent to a 70.5% drop. Not to forget that it fell below US $27 per barrel on 20th January 2016. Most economists estimate that oil price will be range bound from US $20 to US $30 per barrel. Some, including Standard Chartered, estimated that it can go to even 10 US dollars per barrel. But let us explore why is this happening. So this is a chart of demand and supply balance of oil. And if you can see, okay, yellow is demand, supply is in green. You will see that supply here is actually outstripping demand. So according to the data, the supply is outstripping demand by 1.5 million barrels of oil per day. Normally we use the term BOPD in the English calculation, but in the US normally they put BD, barrels per day. So BOPD is more regularly used among the those UK companies and such. So the IEA predicts that this trend could last for the remainder of 2016. So supply would continue to outstrip demand for the remainder of the year. And as long as this trend continues, the price of oil will not recover. So that's why you should avoid investing in any energy-related stocks based on the current trend. But there will be a time when the gap between the two will start to narrow, and that is when we will start to look at some very, very strong and financially sound oil companies. But right now, a lot of even the major oil companies, they are actually reporting losses that amounts to billions of dollars. For example, BP just announced a loss of I think more than 6 billion US dollars, and Chevron also reported a loss in the last quarter, and ExxonMobil, they also suffered deterioration in their profit, and they are actually slashing dividends. So Shell also reported a loss recently. So all these big names, they are actually suffering tremendous losses in terms of revenue and also in terms of profit margin. So we will explore all this maybe towards later half of the year, when it is expected that the US dollar would weaken, and that would provide the support for oil. So why is supply outstripping demand? Number one is global economic slowdown, which curbed the demand for oil. Since 2010, US oil production has almost doubled. So the US shale oil production is the one that swing the production of oil into the oversupply situation. Why? Well, a bit of background on shale operation. Now, shale operation is normally what they call hydraulic fracturing, or call fracking, which they drill a horizontal pipe. So when you drill a horizontal pipe, the moment it bursts those rocks that hold the oil, a lot of oil would flow into the pipeline, and that's when they pump out. So for shale oil, normally the first year of production would see the oil production rise up to few thousand barrels of oil per day, because all the oil is flowing into a horizontal pipe. Now, if you compare that with a vertical pipe, which the oil will flow through a smaller opening at the end of the pipe. So you can see that vertical extraction of oil normally is aided by pressure that cause the barrels of oil to increase, but it will not fall off the production very fast. But shale oil is different, because all the oil is flowing into the horizontal pipe. You will have deterioration by 50% on the second year. Then out of that remainder 50%, another 50% by that third year. So what happened is that the shale oil companies with high production which deteriorate very fast, they will continue to drill even more. So what we have is continuous drilling and more depths, because horizontal drilling is much more expensive than vertical drilling. So that is why the US production has almost doubled. Now, OPEC, in order to protect its market share, refused to lower production to support oil price and instead increase its production. Why? Because they wanted to suppress the progress of shale oil exploration in the US. Now, the excuse to protect market share is actually a very lame excuse. Why? Because up to last year, US oil companies are not allowed to export their oil except refined oil. But crude oil, they are not allowed to export. So the OPEC excuse is actually to want to suppress the progress of shale oil. But because of this, it has become a long and protracted war on the US shale oil drillers, which continue to push the price lower. Now, due to economic sanctions and loss in the value of the ruble, Russia made up the shortfall in oil revenue by increasing production as well. So Russia is now the world's largest producer, and second is the Saudi Arabia, because US production has fallen off slightly. Prior to that, US was the world's largest producer. So when you have all these three countries, Saudi Arabia, Russia, and the US, producing more than 10 million barrels of oil per day, then you can have an idea why it's pushing the price down, because supply is just there and it's not being withdrawn. So this becomes a vicious cycle. We have now low oil price because a lot of the shale oil companies are driven by debt. They have to produce even more because to meet up for the shortfall in revenue due to the low oil price. So they increase production. But the more you produce, the lower the oil price will be. So that is why it becomes a vicious cycle that will only stop when some of the parties actually start to face deterioration in production, okay? Or OPEC decides to reduce production. So let's look at why this vicious cycle is pushing the world towards a major crisis. Now, many OPEC countries require oil to be above $100 per barrel in order to stay within their country's budget. Iraq, Iran, Saudi Arabia, Libya, all these would require oil to be more than $100 per barrel. The biggest casualty of this crisis is actually Venezuela. Venezuela, because of their huge social programs, require oil to be at $132 per barrel. And that is why now Venezuela is facing economic collapse. They have actually run out of money and they are now selling their gold to make up for the difference. So shale oil companies require oil to be above $60 per barrel to break even at an average cost per barrel. As the average cost per barrel is in the range of US $40 to US $60 per barrel. Now, sometimes you might read certain reports from Bloomberg or CNBC which tells you that the shale oil producer break-even level has actually fallen down to $20 20 plus US dollar per barrel, and even at US $30 per barrel, they will survive. Now, don't be mistaken that the break even for the oil per barrel at 20 plus, because that is the cost of the extraction. Now, why my cost here, $40 to $60 per barrel, is higher is because it includes the capital investment of the drilling of the wells, which is very costly, around $10 million to $15 million dollars per well. Okay, and also a lot of them are mired in debt. So that's why it need to service the debt as well. So for the company to really have a break even at the end of its income statement, oil has to be around 40 to 60 US dollars per barrel. Now, deep water exploration costs about US 100 to US 150 million per well. And as a result, major oil companies are slashing manpower, capex, and cancelling high-cost exploration projects altogether. So we won't see any massive investment in oil, at least for the 1 to 2 year period. And because of this, as the market recovers, we can see oil shooting or skyrocketing to a very, very high price when demand overcomes supply, because there's not enough oil exploration, okay, to meet future demand, because everyone now is cancelling on their capex. Now that is why towards later of the year, we will explore some potential oil company, because then we will be preparing for oil to skyrocket. Just as last year, we were preparing for gold to trend up. So that is the cost that we will take for this year. More than 200,000 jobs were lost. Investment in plant and equipment dropped, and the cost to service debt, which has driven the US shale oil revolution, skyrocketed. Now, why US companies could be the next subprime?